to talk about how he is approaching all the results that we've seen so far and, of course, the market on the whole. Manish, hi, good morning. Welcome to the show. Today morning we got some positive news flow that we've seen flows back into emerging market funds for the first time in many weeks. And there's a chunk of that come into India as well. Do you think the FI sentiment is now getting a bit better than what it was about 2 to 3 months ago? Or is there still some amount of aversion towards India?
So I think it's not only about India, right? I mean, if you see over last couple of weeks, what has happened is almost all the emerging market currencies have rebounded quite sharply. So there's definitely been a change in sentiment towards EM per se. And India is just a part of that basket. So I think definitely what will happen is if this recent configuration of dollar weakness and EM currency rebound continues, you should see flows into India continue, which will obviously support the market.
Okay. Well, Manish, good morning. Thank you very much for joining us in our studio. Well, what's the overall sentiment on corporate numbers itself? There is not enough for you to react on, but is the feeling that we are going to see fewer downgrades? We've got some positive IIP number. Yesterday, the non-oil, non-gold imports actually improved. I mean, your thoughts really. Would the earnings season throw up negatives or slightly less negatives than you thought?
So I think if you look at economy per se, we're definitely seeing a very mixed picture in terms of these kind of high frequency indicators you mentioned. So, for example, indirect taxes, airline passenger, petro products consumption. If you see these trends, there's been a positive, but there are some other trends which are not so positive right now. So they're throwing up a very mixed picture. As far as earnings is concerned, I don't think there'll be too much of downgrades because the expectations are fairly low. And basically, if you see at least the headline index constituents, most of the very cyclical components like metals, commodities, etc. Obviously, as a consequence of commodity prices going down, those earnings have been marked to a very low base. So on a market cap weighted basis, these private retail banks, IT, FMCG, pharma, they constitute such a big part of the index. And there, honestly, there's not too much scope of, earnings going wrong. So to that extent, I would think that the worst of the downgrades are over. Okay. But the tricky part today is obviously whether the cyclical rebound will come back not only from a valuation normalization basis, but also from a earnings growth basis. Because if you see over the last 4-5 years, we've kept getting these rallies in emerging markets and as a consequence in India, where, the cyclicals rebound. But after 2-3 quarters, when the earnings don't come through, again the IT, pharma, FMCG kind of sectors start dominating the market. So the tricky part today is to judge whether finally we've seen the earnings of the cyclical part come back.
Okay. You have emphasis in many of your funds that you manage. What did you make of the earnings of the two big ones we saw this time so far, Emphasis and TCS? And given that the second half outlook is muted from the managements themselves, we get a sense that we could now see some amount of underperformance from IT?
So without reference to any particular stock, let me just probably talk about the sector itself. Now, obviously, there is a sector which is very, very large today. IT exports of the order of 80 to 100 billion. So it's not a sector we think will grow gangbusters, in the sense we don't think there'll be explosive growth in this sector. So obviously a lot of these stocks are very big part of the indices, and given our size, we'll obviously tend to have large positions because we have a lot of benchmark oriented funds. Okay. But there is obviously value out there also, in the sense that this is a sector which has high ROE, high cash flow kind of paradigm. So to that extent, it's just a value versus growth trade-off. Okay.
1 minute, Manish, since housing finance companies came with the number, and LIC posted a very
manager at ICICI Prudential. Manish, one of the stocks that you have in your portfolio is DCB Bank, and the last three or 4 days have been very tumultuous for that stock. But the stock is now up about 4.5% after the company, scaled back its expansion plans. As a long-term investor in this stock, how do you react to all this news flow?
Unfortunately, Sonia, we can't talk about a specific stock, so you'll have to let me go on that.
But as a policy, if you, some of these banks, some of these smaller banks, there is a struggle for survival, right, with the onset of payment banks coming through. So do you get a sense that at least they could now become underperformers because of so much competition?
I think it'll be bank specific, but in general, I agree that there is a potential wave of disruption that can happen in banking. It may not be very acute as in some of the other technology intensive areas, but I think apart from payment banks that you mentioned, it's also about the whole digitalization phase of that industry. And the moot point there is whether economies of scale will start to matter in that industry, in the sense that whether the large guys can invest more in technology so that the geographic reach, which was such a big USP of these smaller banks, that is impacted to a certain degree. So if that happens, then obviously people will have to question whether these regional banks, they can grow secularly. Like a lot of them, if you see over the last 20-25 years, have been secular compounders. But I think we'll have to question ourselves whether that phase will continue or not.
No, I won't know the answer. The question is there on the table, Manish. No, I mean, CASA as a way of growing is over for all banks. It was over for banks all over the world. In India, they got protection, but now, I mean, clearly that 1 lakh which can be put into a payment bank, and for which I'm sure they'll pay money, because if Yes and Kotak are still paying you 6 and 7%, the payment banks are going to give you some money, more than the 4% that the legacy banks have been giving. So the CASA game is over in perhaps 6, 12, 18 months. My point is,
would not agree
forget
with that.
the ICICI HDFC Bank, but the entire set of mid-cap banks, even their liability franchise will get challenged by the small banks. In Bangalore region, 2-3 people have got small bank licenses. Jana has got, Equitas has got. They will also snatch away liability franchise, borrowers. And then the payment banks take away your easy money. Mid-cap banks, generally, will you buy?
Well, that's what I'm saying. I think after a long time, banking traditionally is seen as a very static industry. But today, as a mix of technology and regulation, you're probably entering a phase where, a lot of these pillars on which the business model was built, like CASA, I think they'll get more challenging. You also have to wonder whether the share of top 5 will go up or down, because, as I said, with digitalization, their ability to reach remote corners goes up a lot. So it's going to be a very interesting space.
Okay. Another space I wanted to talk to you about was the consumption story. One of the stocks that you own in your portfolios is Bata. And, many of these consumption stocks have fallen 15-20% this year already, perhaps because of no recovery seen in demand. Are you getting a sense that that could be the trend for the quarters to come, or is there some bottoming out that you're seeing in consumption?
Again, I'll not reference it to a particular stock, but sure. Again, I think urban consumption also has been very patchy. You've seen a lot of these retailing stories, both domestic and international formats running here, where the SSG has disappointed.
Yes.
But overall, we think urban consumption will rebound. We're quite positive on the thesis that urban consumption will come back, because I think I've mentioned before, if you see this economy in 3 parts, government, private sector and consumer, the best balance sheet is still with the consumer. The government is on a fiscal consolidation path, the private sector, the capex intensive part of that private sector is still very leveraged. But if you see the consumer and you see the balance sheet size of his real estate and gold holdings, they may not appreciate too much, but the stock is so high versus the debt. Because unlike in many countries, our consumer is not very leveraged. And we obviously have some triggers in terms of pay commission, etc. also coming forward.
So which kind of urban consumption stocks should one invest in?
Well, you have restaurants, you have specialty retailers, autos, so there's a wide variety out there.
Okay. Banks itself, you said that you don't see the top 5 getting challenged. Do you think, therefore, that you will invest more in them because they will be the beneficiaries of the disruption?
That is a possible hypothesis, but again, you have to be very objective and see how it goes, because see, these payment banks and these smaller banks, whether they take away CASA from the larger banks, that is also possible, although I think it will not be felt in the first 3-4 years. But all I'm saying is, let's say someone was getting valued for just owning a banking license, I think those days are gone.
All right, Manish, we'll have to leave it at that. Thanks so much for joining us and giving us your views on the markets as well as on a whole host of other sectors. But